Okay, so let's look at a real world case where it might be interesting and appropriate to improve an entity's profit margins by decreasing sales, by decreasing that denominator. So we'll use as an example the Vermont Organic Apples Company, and they're up in Burlington, Vermont, and we will look at their Q4 2000 XX income statement. Okay, so what they've got here is 20,000 in revenue from their various sales, 14,000 in cost of goods sold. So that's going to go up and down with the products that they sell, right? And other expenses for accountant, stuff like that, $1,000. That gives them net income of $5,000. They're an LLC, so they pay no income tax. Don't have to worry about that. So that gives them a net income margin, right, which again is defined to be net income over revenue or sales. And that equals 5 divided by 20 in most circumstances is a quarter or 25%. So now along walks in an erstwhile investment banker starting out in the Burlington area. And he says, let me take a look at your company and see if maybe we can make it better for you in some way. And Vermont Apples agrees with this. And here's one of the analyses the investment banker does. He says, well, I note that you have two businesses here. You have your just selling apples business, just, pick the apples, sell the apples. And you also have your apple butter business, where you take the apples that you have, you peel them, you slice them, you make sure there's no seeds in them, you add some butter and some honey and some molasses and cinnamon, and you put it in jars, put on labels, and sell that too. So let's look at your company, breaking it down by segment, okay? And so we're looking at the same quarter, and he notes that the company has equal revenues from both apple butter in this quarter and just selling apples. And the cost of goods sold, however, for the just selling apples business is much, much less, right, than the cost of goods sold for the apple butter business. So the cost of goods sold, 50% of sales here and 90% of sales for the apple butter business. And so then he goes on to say to the head of Vermont Organic Apples that, really your area of expertise is in farming, and you're great at growing apples. And the best thing for you to do would be to stick to your knitting. The apple butter business is really a completely different business. It's a retail packaged food business for which you're not an expert. And just imagine if something goes a little bit wrong with your process, you have a little bit of problem in your canning, somebody doesn't seal the lid to one of your jars properly, your customers get botulism, you get sued, you go out of business, the rest of your family is going to be penniless and out on the street. So what I recommend that you do is that you get rid of this highly unprofitable, well, not unprofitable, but much less profitable and much more risky apple butter business, okay? And if you do that, here is what you're going to look like. You're going to be much safer, and your net income margin or profit margin is going to almost double. It's going to go up from 25% to 40%. And of course, you will be able to, assuming the market is good, take the rest of your apples and sell them just as apples. So that'll increase your revenue here with your cost of goods sold still being just 50% of sales. Or you could sell some of your orchard along with the apple butter business and get a big pile of cash, and that would make you very, 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 very happy. So this happens with investment bankers and companies all the time, that investment bankers analyze businesses by segment and recommend jettisoning the least profitable segment that is not a part of what an entity may consider its core business. All right. And in that case, you can greatly improve your profit margins, which shareholders like very, very, very much. Okay. So just as a little coda on this, what happens in the real world with the investment banker? Well, the Vermont Apples, it was such a good pitch that Vermont Apples decides to do this. They sell the apple butter business, and the investment banker keeps the CEO of Vermont Apples in his Rolodex, and he waits between 5 and 10 years, and then he goes back to the owner, and he gives the owner a slightly different pitch. He says, you know what, right now you are in kind of a scary position, because if you have bad weather for a year, your revenue could literally be cut by 50% if another Superstorm Sandy or something like that comes along. And not only that, but all of your revenue happens in the fourth quarter of the year. Really what you need to do is to diversify so that you have more than one source of revenue and net income, and you need to diversify into something where you can get revenues all year round. And what I think the perfect thing for you to do would be to diversify into the apple butter business. And the apple butter business is going to give you something where you can sell out of inventory if you have a bad year with your apple harvest, and it's going to generate revenue for you throughout the year, so your revenue is not going to be so lumpy, and it's just going to be awesome. And by the way, I happen to know someone who owns an apple butter business in the area that is for sale, and we could arrange the sale for you. So that's basically what investment bankers do. They don't really care if the company is fundamentally being improved. They're looking to affect and get fees from affecting a transaction. All right, so that's just my 2 cents on investment bankers. They do some good things too. Okay, so let's move on. COGS and gross margins. I actually snuck in a little bit about COGS margins in this previous example, where I said here COGS was 50% of sales here and COGS was 90% of sales here. Kind of leads you to believe that maybe there's a good way we can formalize that and get an interesting ratio out of it. And indeed we can. In fact, there are 2 good ratios we can get out of this. The first is what I like best, my personal favorite, and hint, 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 that means that's probably the one I'm going to test you on. It's called the COGS margin, and it's nothing more than COGS in the period divided by sales in the period. And gross margin is complementary to COGS, and many people prefer it over COGS margin. Gives you the same information. Nothing wrong with preferring it over the COGS margin. It is defined to be sales minus COGS, quantity over sales. And one thing you should know if you think about the algebra of this a little bit is that if you add up these two margins, you get 1. Okay, so they're always giving you the same information, just in a different way. So focusing on the COGS margin, it helps us to understand how big our product production costs are, how much work per apple, per sales of one apple, the company is putting in terms of costs for Vermont Apple Company. It's also letting us know if our purchasing and plant operations are getting more or less efficient if we look, of course, over time. And if we look at what's going on versus our comps, it's going to tell us how we are relative to other firms in the industry, which is very nice to know. It also, importantly, is not perfect, but it's going to tell us approximately how big our variable costs are. What do I mean by that? For those of you who remember your microeconomics, arguably the only important thing anyone ever learns in microeconomics is that there are costs can be classified into two important tranches. One is variable costs and one is fixed costs. Variable costs are costs that scale linearly with your sales, okay? So that's going to be for, if you're a Vermont Apple Company, the more trees you have, the more trees you have to spray, the more trees you have to visit to pick the apples off the tree, the more trees you have to fertilize in the spring. So the more trees you have, the more these costs are going to go up on a one-to-one basis with the trees that you plant. Okay, so they go in proportion to sales. Fixed costs are relatively unaffected by sales, and we'll talk about them a little bit later. So this is kind of going to be helpful along the way to think about that vis-a-vis the COGS margin too. Okay. Next margin ratio that we have is the SGA margin, which is simply SGA over sales. So it's telling us what percentage of our sales was eaten up by our selling, general, and administrative costs. And what have I been missing here in the past couple of ratios? I've been missing answering the question, is bigger better? So for these ratios, I have a cost over sales. So in this case, smaller is better. And while I'm at it, let's just go back for a second to the COGS ratio. And for COGS ratio, smaller is better, because COGS is, of course, a cost. Okay, so we'll put that in there, and jump back here, and the SGA ratio tells us the obvious things that we would expect, but also, interestingly, it's going to tell us some information about how big our fixed costs are. And our fixed costs, as I alluded to previously, are costs that don't scale quickly in proportion to sales. So, for example, let's continue thinking about the Vermont Apple Company. If the Vermont Apple Company doubles the size of its orchards, is it going to need to hire another accountant or double the amount of money it spends for its accountant? No, not really at all. And imagine generally a company that has 100 employees and they have an HR department of 5 people. If they double the number of employees, do they need to double the size of their HR department? No, probably not at all. Maybe they have to hire one more person. Um, Especially with something like the accounting department. If a company has 100 employees and goes to 200, the size of the accounting department, relying so much on computers as they do these days, probably doesn't need to increase at all. And both of those costs are in SGA, right? So um, this is a reasonable indicator for what your fixed costs are. It's not perfect, but it's helpful. Okay, next up we have the interest margin. Okay, and interest margin is interest that we paid in the period divided by sales. Paid or agreed to pay divided by sales. Okay, and it helps us to understand how much of our sales is going to our creditors, and that helps us answer the question, should we have financed with so much debt? If we look in history, as with all these ratios, it's letting us know if our firm is getting financially safer or riskier. What would be financially safer if it's getting smaller, right? So we want to say here, smaller is better. And I'm going to say to a point. As we go along, we're going to find that having some debt is actually a good thing. So that's why I'm saying to a point. And again, if we look compared to our comps in the industry, we can see if we're doing better or worse than our comps, if we're more efficient or less efficient than our comps in terms of our debt funding. Okay, effective tax rate we are not going to cover, and you should note that any ratio that is printed in gray like this, you're not going to be responsible for. You can read all about it in the textbook. It's just not commonly used, and we have a lot of ratios to cover, so I want to make sure we're focusing just on the really important ones. So now we're ready to do a margin ratio analysis of Continental versus Love. So once again, I have one of our West End advisors generated ratio analysis tables here. And this one is going to be the primary company we're looking at is Continental. We have, as usual, same time period. Most recently reported quarter is the quarter ending 30 June 2008. Got TTM on the right. Most recently reported quarter here, that's Q1. And the quarter farthest into history, farthest away, the oldest is Q8. Okay, and I've got for Continental, I've got the Continental's profit margin, and the second line is always going to be Love. So I've got Love's profit margins for the past 2 years there. And then I've got the COGS margin, the SGA margin, and the interest margin. So let's see, looking at these numbers, if we can answer some interesting questions. Who had better profitability on average and why? Okay, and note here, we're saying during the past year, okay, and I'm saying also on average. Okay, during the past year, on average, this implies to me that we should be using the TTM ratio. So we're going to look at the TTM ratio for this. So really now all we need to know who had better profitability. We need to answer what's the ratio that goes to profitability. Profit, synonym for net income, right? So we want the ratio with net income in it. That's our profit margin, net income divided by sales. And so we know all we need to look at, you're welcome to look at more, but all we need to look at is the TTM ratio for profit margin. How many dollars of net income did we squeeze out of each dollar of sales? Bigger is clearly better. So love clearly at 6% over 0.84% is better. Okay, so who had the better profitability? That's going to be love, and the answer is bigger TTM profit margin. Okay. And who was more consistently profitable? Okay, so now we've got to look, if we're saying who is more consistently profitable, now we've got to look at each 4 quarters. So we compare Q4 to Q4, about the same, Q3 to Q3. So Love is still profitable, less profitable, but Continental has gone negative. Q2 to Q2, Love is still profitable, less again, but Continental has gone very negative. And for Q1, Love is very, very profitable, and Continental is still negative. So who was more consistently profitable? Clearly Love, always positive, right? Continental has gone negative for 3 quarters. Okay, so that's going to be Love here. So let's type that in. Okay, and what can you say about the COGS trend for each company and why? So now I want to look at the COGS margin, and we want to say during the last year. So what can we say about the COGS trend for each company? So I am going to now have to compare quarter over quarter to see the trend. I'm going to have to compare for Continental Q4 to Q4 here, and I'm going to have to compare Q3 to Q3 over here, and et cetera, et cetera. So comparing first for, let's just do Continental first. So 78, 76, not much of a big difference. 80% and change to 80% and change, not much difference. 79 to 84%, that's a big increase. And then 75% to 83%, that's a very big increase. So let's say for Cal, we can say that COGS is increasing materially during the past 2 quarters. All right, and what are we going to be able to say about Love? Doing the same kind of analysis with Love, we see 69 to 71, a little bit of an increase there, 71 to 74. got some increase there. And 74 to 75, and then finally 67 to 73. So that's a significant increase too. So we'll say love also increasing. Okay, there we go. All right, and let's now move on to our third ratio analysis framework, which is turnover ratio analysis or efficiency ratio analysis. And we'll see how these work in just a second when we come right back.